Bank of America shut down. The hidden agenda behind account closures. Banks desire to cut costs and streamline operations. One of the reasons Bank of America may shut down accounts is cost cutting. Banks often review the profitability of their customer base, and accounts that incur high maintenance costs, such as those with low balances or frequent overdrafts, might be closed. Additionally, banks may reduce their physical branches or customer service operations to focus on digital banking, leading to closures for customers who aren't aligned with these cost-saving measures. Regulatory compliance and legal risk. Banks are heavily regulated and must adhere to strict financial laws. If an account is flagged for suspicious activity, non-compliance, or involvement in illegal activities such as money laundering, the bank may shut it down to avoid legal consequences. Regulatory bodies like the Financial Crimes Enforcement Network, FinCEN, require banks to take action when accounts are suspected of violating financial regulations. Sometimes, account closures are done to protect the bank from potential penalties or legal issues. Customer behavior and risk mitigation. Account closures are sometimes related to a customer's behavior. High-risk customers, such as those with a history of fraud, frequent chargebacks, or abusive banking practices, may have their accounts terminated. Banks prioritize minimizing risk, and shutting down an account seen as problematic can be a preemptive measure to avoid financial losses or reputational damage. If a customer engages in activities that go against the bank's policies or poses a financial risk, account closure becomes a proactive defense for the bank. Shifts in banking strategy and profitability. Banks frequently reassess their business strategies to maximize profits. This can include consolidating accounts that don't align with the bank's current financial model. For example, if a customer holds an account with minimal activity or balance, it may no longer be a profitable customer for the bank. Banks may choose to close such accounts as part of a larger strategy to focus on higher value customers or more lucrative services like loans and credit cards. Increased pressure from digital-only banking models. The rise of digital banking platforms and fintech companies has put pressure on traditional banks to adapt. Some branches of Bank of America may close accounts in favor of pushing customers toward digital solutions. With digital banking becoming more streamlined and efficient, the need for maintaining traditional account types, especially those with low engagement, diminishes. Customers who do not adopt online banking or are not aligned with this digital shift may face account closures as part of the bank's broader efforts to modernize its operations. Conclusion: the closure of accounts at Bank of America is often driven by a combination of cost-saving efforts, regulatory compliance, risk management, and shifts in banking strategy. While these closures may appear to be part of a hidden agenda, they are typically part of the bank's attempt to minimize risk, increase profitability, and adapt to the changing financial landscape. Customers who experience account closures should contact the bank for clarification, review their account activity, and ensure they are in compliance with bank policies.